Hello and welcome to today's webinar, How to Build a Financial Plan Investors Will Love, presented by Early Growth Financial Services. My name is Patty Montoya and I'll be your moderator today for Early Growth Financial Service team. I have a few quick notes before we get started. The webinar will last about an hour and that includes time at the end for questions. So feel free to type your questions into the control panel and we'll answer them between slides. The next thing to note is that this webinar will be recorded and sent to all the registrants with the slide deck within 48 hours. You can also find this recording and all of our recordings on our YouTube channel, Early Growth. Now, before I pass this off to our speakers today, I would like to tell you a bit about Early Growth. This is a quote from our founder, David Edinburgh, and a few of our clients we've worked with. And here's a quick description of what we do. We are an outsourced finance and accounting firm. We work with early-stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuations. Now, without further ado, I'd like to introduce our panelists, Alaa Ismail and Sirk, who will tell us a bit about themselves and kick off today's discussion.
Hi, everyone. This is Sirk, and I am a consulting CFO with Early Growth Financial Services. I've been with the firm for about 5 years. And prior to that, I've been working here in Silicon Valley, assisting companies. Started my career with bigger companies back in 1996. And worked for a few years at 3Com Networks and Palm Computing. And then I switched over to startups, and I've been assisting startups with a financial expertise since then. And thank you very much for your time today on this webinar.
Yes, good morning, everyone. My name is Alaa Ismail. I'm a consulting CFO with Early Growth Financial. In my about 7 years with Early Growth, I've worked with a lot of exciting startup companies and took them from a very early founding position all the way to some of them now are public companies. We did not take them public, obviously, but we were involved in the initial formation. My career goes back to from public accounting to my first startup corporation was in 1999 and went through all the way to an eventual exit acquisition by a larger company. I have fairly extensive experience in a lot of different industries, ranging from e-commerce to SaaS, and I'm happy to be here.
Fantastic. So let's go ahead and get started. And so really the objective of this webinar is not to really get into the nuts and bolts of spreadsheet manipulation and that type of stuff, because you can find lots of examples online and talking with experts. But this is really kind of a mindset, discussion of a mindset of what we should be thinking about as we prepare a financial plan that investors will ultimately love and hopefully fund for your company. And so kind of the beginning of that is really, thinking about, getting buy-in, right? Buy-in from the company in terms of what we're trying to achieve, right? So what are the major objectives that we are trying to achieve, both long-term, and then maybe even more importantly, some of the major milestones that we're trying to achieve with this round of financing, right? So, if you think about fundraising, right, in most cases, you're going to do it in multiple steps. You're going to raise some amount of money initially to get you started, and then you're going to raise a little bit more money to maybe go to market, and then do a Series B after that to expand the market and expand the company, and so on and so forth. And with each of those financings, what we're trying to do is we're trying to achieve milestones such that we are able to increase the company valuation and make it easier for us as we grow to continue to get financing assistance from venture capitalists. And so we'll be talking a little bit about, we'll be talking a lot about milestones. And then finally, as a kind of initial thought process is really to get agreement, right, from the leadership team. When you first, if you're doing like a seed round of financing in the early stages, it may just be you, or it may be you and a co-founder, and so that's all it may be, and it may be one or two people really thinking about what we're trying to achieve. As we get into later stages of financing, then we'll have probably a bigger team, right? We may have a CTO, and we might have a chief revenue officer or a chief marketing officer, and so there will be other parties that will need to be involved, and everyone needs to really buy in to both the objectives as well as the financial plan that is being generated, so that everyone feels that this is an achievable plan with the financing that we're trying to raise.
So the next kind of track that you should consider is what kind of resources do you need? And I think the best approach to do that is to look at your company or your enterprise by department. When we say department, we just mean operational activity. So the departments are things like sales, marketing, engineering, product development, general administration, legal, those kind of departmental approach. And when Sirk in the last slide was talking about stakeholders and your management team, this kind of feeds into it. When you look at it by department or by operational expense, you involve the folks that are in these operating departments, your chief revenue officer, your sales and your marketing officer, etc. And then once you have that, you then could go to the next level by looking at other spending buckets. The number one, of course, and usually the largest expense item, is your staffing. So it's really critical to look at your staffing needs and match that to the various milestones, especially the milestones that we'll talk about later in your fundraising, and try to figure out, what kind of resources you need and apply some dollars to that forecast. You should also look, the next big bucket is, especially early on for startup companies, is professional services, consultants, outside resources. You should definitely look at that early on in your company's development, because that tends to be a larger component of your overall expenditure early in your company development. The next one is contracts. A lot of times, especially with engineering-driven companies, there are contracts for development. Maybe you're utilizing other software packages, or you're licensing some hardware, or utilizing consultants that will help you in your product development track. So make sure you look at that. And then finally, general administrative items, things like travel, legal, accounting, of course, and facilities should be looked at, along with marketing. Typically, very early in the company, especially for pre-revenue, sales might not be a primary focus, but if it is, then take a look at that, especially sales commissions, and your overall sales cost in the departmental review. Next slide, please. Yeah.
So let's talk a little bit about revenue, because obviously on the expense side, we obviously need to know what kind of spending we're going to be doing. But the ultimate goal of a company is, unless we're trying to just build a company that is going to grow in size in terms of people and eyeballs and whatnot, and sell to a bigger company, the ultimate goal is obviously to make money. And the way that we make money, obviously, is by revenue. How much money we're able to bring in, and this is probably one of the most difficult parts of the financial modeling to get right, especially at early stages, right? Because if you've got a history of revenue growth, and you kind of understand what the market is doing and understand who our competitors are and where we fit in the space amongst the competitors, then it's a little bit easier, right? We've got history to fall back on. But at early stages, it's really, really hard to do, right? Because we don't have that history, and so we have to make some assumptions. And so we'll talk a little bit later on about using assumptions and how to use assumptions to drive the model. But here's some kind of high level stuff that we need to be thinking about initially. And one of the first, kind of no-nos is using just kind of growth percentages, right? I've seen lots of financial plans that are put together. I'm sure Alaa can attest to this as well, where a team kind of comes in and says, oh, you know what, I think we're going to be able to do $1 million of business in the first year, and then I think we'll be able to increase it by 50% in the first year and 40% in the second year, and they use kind of just these percentage increases either month over month or year over year. And that's how that's kind of what their assumption is in terms of growing their revenue. And obviously that's not enough, right? Because ultimately, while we may believe that, we need to convince our investors, our potential investors, that there is a good thought process and an understanding of what we need to do to drive to the revenue, and using the correct assumptions or appropriate assumptions, and being able to convince our investors that we're using appropriate assumptions is going to be key. And so, stay away from that. Obviously, understanding the revenue drivers, right? And for obviously different companies, it will be different type of drivers, but it may be about things like, about customer acquisition costs and how long does it take to acquire a customer, and what their lifetime value is, and what kind of churn they are. So those types of drivers, and where are you going to go ahead and market, and how are you going to market, and what percentage of the spending that you're spending is going to turn into revenue. All those types of drivers are the things that we need to understand, and then we'll use those drivers to be able to build a model, based upon some of the assumptions that we'll talk about later. One of the things that I think is a really, really good way of doing it, if we've already got some history, is really understanding things like, okay, if we're driving sales through a sales team, right? What kind of history do we have, or what kind of comps can we use to determine, dollars of revenue per salesperson, and so that may drive, how many salespeople we need, and it'll certainly help us to derive, what kind of revenue growth that we can see, and so those are some of the high level stuff that we want to be looking at when we first start looking at revenue, and we'll dive a little bit deeper into some of the assumptions of the model a little bit later.
So obviously, when you're doing all this, you need to kind of organize it in some fashion. And of course, the ubiquitous Excel spreadsheet is really the tool of choice for forecasts and financial models. It's amazing with all the different tools that are out there, and with all the different software forecasting companies that are out there creating different tools, how in almost every single financial planning and analysis department, that Excel is the primary tool. So you have to create spreadsheets. And one thing that we did not mention very early on, depending on where you are in your at the stage of your development, please have a financial professional help you through this if you have not done this process before. They will be able to guide and make sure that you're considering all the different factors. So I'm backtracking a little bit because I don't think we really mentioned it, but I think getting that help early on will help in this formation, and all these slides will make a lot more sense, and make you a lot more efficient, which is really the idea here. It's to be efficient and to present a professional financial picture to a prospective investor. So typically Google spreadsheets or Excel spreadsheets are used, depending on what you're more comfortable with. You should format your modeling spreadsheet in the exact same way that you're looking at your overall forecast. So we talked a little bit about expenses being divided into departmental buckets like sales, marketing, engineering, and so on. Your spreadsheet should also be formatted in that way. So you create a separate cost spreadsheet for the different expense centers. You create a one or two or whatever number of tabs in your spreadsheet for your revenue forecast and projections. And then when you have all of that, you should also kind of put that together in a comprehensive financial statement. And we'll talk a little bit more about that later. But please utilize some kind of tool like an Excel spreadsheet to kind of put all that together. And as you're going along, make sure you have an assumption worksheet. Don't assume that you're going to remember every single assumption that you make as you're creating these models. You're going to be making a lot of assumptions: revenue growth rates, revenue churn rates, customer acquisition costs, all these different assumptions that you're going to be making. Put them down in an assumption sheet as you're creating the spreadsheet. And then at the end, you could go back and eliminate things that are either not necessary or redundant. It seems like an obvious thing to do, and I think most people, when they're doing that, they're not creating these on a piece of paper. But just make sure to organize your spreadsheets properly so that in case somebody wants to look at it later, it could make sense, and get some financial assistance when you're doing that, if possible.
Yeah, and I'll also add to that as well. Really great points. Because if you're already experienced at putting together financial plans and you kind of know your way in and out, then obviously then that's great. Especially if you don't, though. I think you could get really caught up, right, with and you could either get really bogged down in details, or you're not able to even kind of prepare some of the backup documentation that's really required. And so talking with, or just even if you have other entrepreneur friends who have been through it, use them. If you have financial professionals that obviously ping them. But yeah, if you haven't done this before, or if you're not that experienced with it, getting some assistance from professionals is definitely a way to go. And then the other thing I'll just add to what Alaa said with regards to creating a worksheet of key assumptions, and we'll talk about this on the next slide. But this really is key, because ultimately, the investors are probably not going to question the numbers on the spreadsheet, right? They're not going to question the revenue number. They're not going to question the expense number, but they're going to question the assumptions that you use to come up with those numbers, right? And that's really going to be the driver for the investors as to their sense of their confidence in you as an entrepreneur, you as a founder, as someone who's putting together a financial plan for them, that you know what you're doing. So absolutely key. And then let's move to the next slide, and we'll talk a little bit more about these key assumption worksheets. So we find that, and I think if you've experienced it, you will find this as well, that a financial model can be pretty complicated, right? There's a lot of inputs. There's headcount, there's revenue growth, there's market sizes, there's so many different assumptions, and growth rates and things of that nature, hiring plans, marketing spend, how much are we paying for rent, how much are in telecommunications costs, what about server costs like AWS or Amazon Web Services. There's a ton of things that you're going to be entering in here, but I think you're going to find that some small number of assumptions, the key assumptions, are going to really drive the model, right? So yes, you need to put down an amount for rent, right? Office rent, right? But whether it's, whether you're going to be paying $4,000 a month or $8,000 a month in rent is really, really not going to make the big difference, right? It's just not as material as, some 5 to 10 key assumptions. And those, and so think about, what those are, right? And the model will help you kind of navigate through that, because you'll be able to kind of play around with it and change the assumptions and see what happens to the model. But if you kind of going back to the previous slide from Alaa, if you have a key assumption worksheet, and if you're kind of driving your model based upon those and linking the model to your key assumption worksheet, then as you change those and as you kind of play around with them, you can see what happens to the model. And that's kind of a key way of doing both, just keeping your model dynamic, as well as being able to run different scenarios, which we'll also talk about. But, so some of these key assumptions, right, would be things like, revenue per salesperson, revenue per, marketing spend. If you're in a SaaS or a software as a service model, which a lot of our clients are, then you'll want to look at things like, customer acquisition cost and lifetime value or customer lifetime value, your churn rate, or how often and how quickly do our customers leave. Those key assumptions are going to really help drive, what the financial model looks like. If you and even like, kind of, looking back or a little bit more wide ranging, not just SaaS companies, but things like, the size of the market, right? What's the market we're going after? What kind of market penetration ratios are we trying to achieve? Are there segments within the market, in a big market, that we're trying to go after first, and what kind of penetration can we expect, and what are our plans to reach those? So those are kind of the big key assumptions that I think you should think about first and foremost. Spend the bulk of your time focusing on those, and then the 10 to 20% of the time to kind of fill up the rest of the model with some of the other obviously factors, but not the key factors. We'll kind of fill it out.
Okay, so you've now gathered all the different components. Now is the time to kind of look at the landscape that's ahead of you and the budgeting and financial planning kind of landscape. So we've talked about identifying the key variables in your forecast, things like revenue, cost centers, hiring, and so on. We've gone into great depth about revenue forecasts and the related assumptions around that. And then once you have all that information, then it's time to run different scenarios. I think especially for your fundraising plan, you don't want to just kind of gear the scenario to one assumption. Remember, you're going to be probably presenting to various sources for fundraising. So it's good to look at different scenarios, not just for the fundraising process, but also for your operational process. What happens if we hire more salespeople? What happens if we invest more in marketing? What happens if we, decrease our hiring plans for the year one, and what happens in the second year? So just kind of look at the different scenarios by yourself and with your team, and see what kind of makes sense, and which operating plan that you think it best fits the stage of where your company is at the moment in time. And then after you do that, let's look at a forecast on a 3-year plan at the very most. I see forecasts running up, 5, 6, 10 years, and just to know that investors and people from the outside rarely look at anything beyond 3 years, because in the current business environment, anything after 3 years is just unknowable. So typically, we will talk about the forecasting process. Typically, I like to do a bottom up, and we'll explain what that is later on. Plan for year one, a year out, and then a top down for year 2 and 3. But we'll talk a little bit more about the difference between a bottom up and and top-down forecasting process. But your forecast should not go beyond the 3 years.
Great. And now let's talk a little bit about, not only just the financial plan itself, but kind of the mindset that we should have, as we think about the financial plan as a way of fundraising, right? Because that's ultimately what this is about. Yes, we're putting together a financial plan, for operational sake as well, and maybe putting together some initial thoughts about hiring plans and expenses and so on and so forth. But ultimately, right, the goal of this exercise, at least, is to assist us in fundraising. So let's go to the next slide, and we'll talk about one of the ideas that's kind of really near and dear to our hearts as consulting CFOs when it comes to fundraising, because this is the way that investors think about it as well, and that's milestone fundraising. And so let me kind of just explain even without getting into the details of the actual financial planning. But if you think about it from an investor standpoint and a company valuation standpoint, right? You're going to be going through multiple rounds of financing, hopefully, during different phases, to help grow the company and turn it into a big successful company. And as you're doing that, hopefully the valuation of the company is going to grow, right? But the valuation doesn't grow in a linear line or even an increasing slope line. Rather, it takes actually big step functions in terms of increases in valuation. And those big increases in valuation happen when you hit milestones. So that's why we say, okay, let's think about what milestones we're trying to achieve, and let's plan on this next round of financing and what we're planning to do with that money. What milestones are we trying to achieve? Are we trying to finish product development or get product development to an 80% stage with this round of financing? Because then if we are able to do that, then we can argue that our company is going to be much more valuable, and our next round of financing is going to be easier. Are we at a stage where we're really focused on gaining customer traction? Then let's put in some milestones in terms of the amount, the number, the revenue amount that we expect to achieve, market penetration. Those types of milestones are really what we're trying to finance and what investors are really financing. And so that's how we want you to be thinking about it as you're putting together this model. And so then obviously, then you think about, okay, we need to finish product development, and we're trying to raise money that is going to allow us to hire this many engineers or this many product development people over a certain period of time. And so we're trying to raise 18 months of cash, and with that, we're going to hit this product development milestone. Well, how much resources are we going to need? How much time are we going to need? And in terms of resources, that's obviously a matter of a lot of things like do we feel how confident are we that we're able to hire the right people, the right number of people? How much money do we have? And obviously that kind of circles back to how much we're trying to raise, and how much time. And speaking of time, this is a question that gets asked. How much time should we be trying to raise for? Like should we be raising enough money to get us through the next 12 months, the next 18 months, the next 3 years? And this is a question that gets asked a lot. And typically, I think what we try to tell people is that you want to try to raise for an 18 to 24 month cycle, right? And there's two reasons for that. One is that beyond 18 to 24, well, first of all, you should be achieving some significant milestones in that time frame, so that in 18 to 24 months you'll be able to raise a significantly larger round at an increased valuation. And then secondly, it has to do with our ability to be able to really to kind of contemplate what is going to happen in that time frame, and beyond that. And so investors are not going to want to raise a lot of money at this point in time to be able to keep you going for 3-year time period, you're going to want to do it in tranches, and this is the way of doing it, is to raise for about 18 months. And then obviously give yourself a buffer, right? So you put together a financial plan, and you kind of assume that there's going to be, some twists and turns. We may need to do a little bit of pivot. Things may take a little bit longer than we originally think it's going to take. And so giving yourself a little bit of buffer, so that the worst thing that can happen is for us to raise some amount of money on a financial plan, run into some problems along the way, and then realize that we're running out of money, but we haven't met the milestones that we originally intended. And therefore, that really keeps us from being able to do a good job of raising that next round. And in many cases, the fact that we didn't have a buffer kind of almost spells the doom, right? Because then when we go to raise more money because we're running out of money, then the new investors, basically ask, well, what happened? Clearly you didn't achieve, you were not successful in achieving your milestones, and now you're coming and trying to raise more money when you really haven't, really increased the valuation of your company. So that either leads to unsuccessful financings, that could lead to down rounds, meaning the valuation of the company has decreased from the previous round, and that obviously leaves a bad taste in the mouth of both current investors as well as the executive team.
So before we go on to the next slide, I just wanted to mention the planning of your raises should be really not the primary goal, of course, of your operation. You're going to be focused on developing a product, increasing revenue, and so on. But keep in mind that the investors are kind of looking at an upward trend in your business, or the achievement of the next milestone. So that milestone that you've kind of created in your fundraising should piggyback onto your operations. So to the extent that things are not working well, you're going to have a little bit of a buffer, like Sirk just mentioned, but it's time to kind of get on track and reassess how you're doing things internally, so you could achieve the milestones that you've promised to either your prior investors or your current and your future investors. So that milestone setup is great operationally, and it's also will help you with valuations and investor relations. I think we have to go back one slide.
No, I think this is. Oh.
After the milestone.
Patty, could you go back to the slides?
Which one?
Be on the trade-off slide.
Hey.
So the time frame and forecasting in your forecasting is that as Sirk mentioned, that you should be kind of planning on a 24-month cycle. Investors really look at things in 3-year cycles, but it's really not the years as much as the milestones. So, for example, if you are in a product development stage, your investors are going to want to see progress towards that product development. They want to see customer validations and so forth in the product development stage. So investors kind of look at things in 3-year tranches, but more importantly, they kind of also tie that into your operational achievement, whether that's product development, revenue growth, or so on. Things will change, and the one thing that I my experience has shown me, there's no such thing as a plan where you're going to raise a seed round this year, and in a year and a half you're going to raise an A round, and so on. Things will change. The investment scenario changes. Your product development will not go the way you plan. The customer base that you thought you were going to address is going to change. But the idea of being a startup is that you need to be nimble, and you need to be nimble in your operations, and you need to be nimble in your forecasting. So expect things to change, and change your forecast accordingly. You may start out thinking that you're going to address a certain market segment in your revenue, and find out along the way that, hey, there's other avenues, or there's other market segments that really need your product, and now you have to pivot. And that pivoting and your ability to move and be nimble is really a key function of being a startup. And that's what investors will expect you to do, and you should be ready for it. The other item is that when you're doing a forecast, it's not just something that you present to investors, raise your money, collect your money, and then stop. You'll find that forecast is an operational tool that you'll be using all along your company development path. So that forecast will, as you're kind of updating your actuals and you're updating your forecast, will also help you understand your cash needs and the related burn. And that will also guide you to adjusting any kind of assumptions that you've made, say, in the prior raise, and help you figure out when your next raise is going to be. I've seen things go both ways. I've seen companies, unfortunately, this is probably the predominant, where their spending is a lot higher than they expected, or their revenue has not grown what they expected. So instead of raising another round in a year, they may have to push that back a little bit. Or there are situations where the product acceptance is a lot more successful than that companies expect, and your revenue is increasing at a much faster rate. So now the time. Maybe you don't need to raise another round, and you could kind of turn that dial back. The point here is that without a proper kind of accounting and forecasting structure, you really don't know where you are, and that's an important thing to have as throughout your company development process. So it's a roadmap. It tells you where you've been, and also helps you figure out where you're going. Next slide.
Yeah, thanks, Alaa. If we're in an existing business, meaning that we already have a little bit of history, right, both from an expense standpoint and revenue standpoint, then the financial planning becomes a little bit easier, right? We have history to fall back on, but obviously we shouldn't just use that history. But clearly we want to look at the trend, right? We want to look at the trend of what's been happening with our revenue. We want to look back and see whether we made the right decisions in terms of hiring. Did we bring on salespeople too quickly, or maybe we were late to a certain market because we didn't hire salespeople enough? Maybe there were some features in our product that we needed to that we should have included that we didn't. Well, those are the things that now we have a better understanding of, and it'll absolutely help us, as we put together a financial model for the next round of financing, or in this case maybe a Series A or a Series B, as opposed to a seed round of financing. And so we want to take a look at the trend, and we want to take a look at what the prior year's revenue and spending was, because that obviously gives us a foundation to be able to plan for the future. But as we do that, then what we do, we want to layer on our understanding, our additional knowledge of the marketplace, our additional knowledge of our company, of our team. What resources do we have? What resources do we need to fill out gaps? and using all of that to be able to put together a forward-looking 2 to 3 year plan that uses the history is obviously the way to go, and it'll obviously have a lot more credence with the later round investors who see kind of what we've been doing. Now, obviously, we need to be able to back that up with hey, look, this is what we're doing. This is why we're showing a big increase in revenue, for example, because we started in this one segment of the market, and we were successful, and now we're ready to branch out into these two adjacent markets, for example, and these are the resources that we need, and that's why we're coming to you for additional financing so that we can fill out our team to be able to really attack these new market segments, for example. It very well may be that we, as Alaa mentioned, we talk about changes in forecasts and pivoting our company. It may be that hey, we weren't as successful as we wanted, but along the way of not being as successful as we originally planned, we learned a lot of things, right? We learned that maybe the initial market that we were going after wasn't as big, or that it was a little bit harder to penetrate. But now, we've made some progress, and now we're in a better position than we were in, and we really think that the right thing to do is keep on going after this segment, or maybe a different one. So those are the kinds of things that we want to be addressing, and those are the assumptions that we want to be adding to our model to be able to to put together a forward-looking model with some historical background. And then let's just talk a little bit about kind of the financial projections, and there's really two kinds that you can use, and there's good and bad examples of both. I think Alaa kind of already touched upon there's two types: top down, bottoms up, and Alaa's a big fan of bottoms up for the first year, and maybe doing a little bit of top down in future years, because we don't have the visibility. But let's just kind of talk about both of those, because we want to be able to use examples of both in our financial modeling. And the first one will be a top-down financial projection, and there's both a good use case and a poor use case for this. And this is kind of the one that we would certainly recommend, especially for really early stage companies trying to model out what their revenue might look like. And that's where you kind of use this funnel approach, right? Where you start with a total market size that we're going after. We identify particular segments, and then we extrapolate what the potential revenue is going to be. And for again terms of art here, you use things like TAM, or total available market, SAM, which is the serviceable addressable market, and then SOM, which is the serviceable obtainable market. And so those are acronyms you'll see as you put together financial models, and as you look at kind of marketing strategies and things like that. But that's really where you start, right? When we first start out, we're not like, for example, I like to use a very simple example of somebody trying to open up a sushi restaurant, right? The worldwide market for sushi may be, I don't know, $10 billion a year, right? But if we're opening up a sushi restaurant here in San Jose, the serviceable attainable market, may be a radius of 10 miles, from the location that we're trying to open up. And so, using this kind of funnel approach, starting with a total market size, identifying particular segments that we initially want to go after to extrapolate, and then saying that we're going to be able to address, or we're going to be able to win this percentage of that market is kind of the way to use a top-down financial projection. The way that you don't want to use a top-down financial projection, and I've seen this as well as a poor example, is someone who kind of says that, hey, look, this is the kind of revenue that we're going to be able to generate, and then from a tops-down perspective, I'm going to say that, hey, I'm going to use I'm going to spend 30% of our revenue in R&D, and I'm going to spend 40% of our revenue in marketing, and then 15% of our revenue in G&A, which kind of gives me some net operating income. And so I have seen people do that just to be very, very simplistic and put some numbers on paper. And obviously, it goes without saying that that's not the right way of using a top-down financial projection.
Okay. Next slide, please. Hello?
Yep, we're there.
Yep. Are we on the financial projections that you're going to be considering, and we're going to get into a little bit more detail. And I think Sirk has talked about the top-down financial projections, and I'll talk a little bit about bottom-up financial projections, and both are really important. I've seen, and I think the most effective is to use the bottom-up projection method for your forecast method for year one. Remember, we're building a 3-year model in most cases, and then you could utilize a top-down projection approach for year 2 and year 3. Simply, if you have the information to utilize a bottom-up going up for year 2 and year 3, that might be helpful. However, as things change, it's very, very difficult to get into that kind of minutia that's required, or the detail that's required in a bottom-up financial forecast for out years, for 2 and 3 years. Remember, this is a changing, rapid business environment in most cases, and your financial projections and related assumptions will likely change. So to figure out what's going to happen in year 3 on a bottom-up basis becomes very, very difficult in my experience. So by looking at things kind of in a 1-year tranche bottom-up, you're basically you have a lot more focus and a lot more information to be able to do that. And that 1-year projection, it's not just, you don't do this on an annual basis. I like to consult with my companies and tell them that their forecasting should always be, forward-looking. So if I'm in the second quarter of my fiscal year, I should be also looking at the first quarter of the next fiscal year from a bottom-up for my projection. We've talked about how important this exercise is because it's a great operational roadmap for you to follow, and it helps also guide your team based on financial results and what your stated expectations were. Next slide, please. Okay, next slide, please.
Hey, Alaa, I think you may be your slide set may be going a little bit slower because we were on the bottom-up financial projection slide.
Okay.
So
right.
let me add also to that, what Alaa said. So, kind of doing a rolling 12-month bottom-up financial plan is the way to go. But always, as you're kind of doing that, right, think in the back of your mind, or even in the forefront of your mind, think about those milestones, right? Think about the milestones that we're trying to achieve, and does my bottom-up model, or does my bottom-up projection meet these milestones that we're trying to achieve, right? Are we going to be able to get the revenue targets that we've achieved, that we've set for ourselves with the headcount planning that we're doing? Does our marketing spend support the amount of revenue that we expect to generate? Thinking through those ideas, constantly, and as Alaa said, even on a quarterly basis, kind of rethinking that, what happened in this past quarter, will help us to guide the financial planning, so that. And you do that quarterly, even though you're not going to fundraise. Let's say you just raise the Series seed, and it's going to be 12 months from now before you actually go out again. But if you do this on a quarterly basis, then you're kind of prepared, right? You see the pivots happening, and you see and you're much more prepared to put together the financial plan that you're going to be presenting to investors when you go after the Series A round of financing, for example. So that's I think that's that's kind of the last thing that we want you guys to be thinking about as you put together this financial plan.
We have a question. How does a company projected revenue growth without first considering the total market size, particular segment, etc.? In other words, to start at the bottom for bottom of it seems one first needs to do top down.
Yeah, absolutely. So I completely agree with that. So especially if you're like for example, if you've got a history, like if you've already got 12 or 24 months of revenue, then obviously you've got some history to go by, and you can say, hey, this is what we've already done in terms of actuals, and then this is the growth that we expect over the next 12, 24, 36 months. But initially, if you don't have any revenue, or if you're really in the early stages and you expect to see a huge ramp in revenue, the hockey stick in revenue, for example, then obviously you do want to start with a tops down. And that's kind of what we touched upon, right? So start with a market size, narrow that down to the market segment that you're going to be going after, and then think about the assumptions. So for example, let's say you got a total market size of $1 billion. And ultimately, the first market segment we're going after, whether it's geographic or a certain industry within the entire market, let's say that's $100 million, right? And that's really the market that we're going after. Then the assumption that we should be thinking about is, okay, well, what percentage of that $100 million am I going to be able to get in year one? Is it going to be 1/10 of 1%? Is it going to be 1/100th of 1%? And how does that grow from the 1/10 of 1%, for example, to 1%, to 5%, and then ultimately become a leader in the space by having 10 or 20% of the market? And the assumption. So what am I doing? What's the secret sauce of my company? The technology, or the marketing prowess, or the sales prowess, or the networking that I have? What are the things that I have that is going to enable me and my company to be successful in this space, more so than my competitors? And being able to communicate those assumptions as you and layer that upon kind of the revenue model that you're putting together, is what's going to ultimately win over the investors.
Well, let me add one more thing, especially if you're in a very early stage of your business. If you're thinking about revenue in the next year, you've obviously thought about a methodology of how you're going to achieve that revenue. So if for example, if you have a direct sales approach, even though you don't have any histories, you might have an expectation of what your salespeople should bring in on a quarterly, semi-annual, annual basis. So if that guides your forecast, that's better methodology and a better assumption than, the going back to the sushi market, what percentage of the sushi market you're going to achieve in year one. If you're a SaaS company, and just purely indirect sales by hits on your website, make some general assumptions of how many hits you're gonna be able to convert. Use a little bit of thought, even if you don't have any history, that gives the investor the comfort that you're not just kind of winging it, that you've kind of created a process that you can track in the future to see if you're being successful in your revenue. The notion that I have no experience and the company is very early in its stage, so I have no idea what my revenue is. It might be very, very true, and at the end of the day, might be the way that you're going to go out. But I think investors expect a little bit more thought in your go-to-market strategy. So try to pair that with your operating expectation of how you're going to achieve your revenue into your forecast. So the more detail and the more thought that you have on it, the more I think the investors will appreciate that and are able to question it a lot better than, say, 10% of the your local sushi market within a 10-mile radius. So that's just kind of my 2 cents in that process.
Excellent point, Alaa.
And then the last question would be, do you have a template for a financial model that you recommend, or how would one go about it?
Yeah, I'll take it. The one thing that I would go back to, and I'm really not trying to punt, but typically the investors are going to want a financial presentation in financial statement format. If you do not have any experience with presenting your forecast that way, then I would recommend going out and finding either a resource, either prior examples, and there's a ton of them online, or spending the money. I mean, and talking to a financial consultant to give you that model, that template, that the guidance that you'll need going into a financial plan without that the general accounting provisions. For example, if you're a SaaS company and you're planning to get quarterly, annual licenses, you want to be able to reflect that properly on your financial forecast, because investors are going to want you to be able to recognize the revenue over the term. And if you just say, you know, my revenue in January is going to be $12,000 because I've gotten 12 one-year $1,000 contracts, the investor is going to kind of look at you as an unsophisticated operator. So getting financial help is very, very important. Otherwise, kind of look at on the internet. There's various examples of presentations that you might be able to find in your particular market segment, and or ask around for other folks who have created templates in similar industries, and that way you'll be able to at least have some examples. There isn't a ready-made forecast template that's out there, just because businesses are just so different, and key points are so different. So I've not had experience with one example that anybody could just kind of go online and take and follow from that point on. Sirk, have you gotten?
No, there isn't. I completely agree with that, Alaa. Yeah, you know, if you search online, if you know your industry, you know where some of the resources are available. You know, start with those. But as Alaa mentioned, and I'll certainly echo, you know, let's look at, you know, two of the biggest companies we know, right? Apple and Google, right? Those are two huge companies, you know, but their financials look completely different. And so even understanding, you know, some of the nuances of a P&L or a profit and loss or income statement versus a balance sheet versus a cash flow statement, all of that has to be really married together for you to get a full understanding of what's happening with your financials. And as Alaa mentioned, you're going to be expected to know that. Investors are going to expect you to know the differences. And so, for example, you may say, hey, look, I'm planning on doing, you know, $1 million of revenue. Well, you know, what does that mean in terms of cash coming in? That may be a very different number depending on the kind of company that you have, right? If you have a product company, $1 million of revenue may be $1 million in cash. If you have a SaaS company, $1 million in revenue may be a lot more than $1 million in cash. Other companies are the exact opposite, where, you know, you may generate revenue, like, for example, if you give terms to, you know, big companies and it takes them a long time to pay, our revenue may be greater than the cash that we're bringing in for that amount of revenue. So all those nuances are really impossible to put into one kind of standard template, or and so, you know, understand your industry, understand kind of what your financial statement should look like, based upon, you know, other examples out there that are similar to your business, and look for those kind of templates online, and then absolutely work with a financial professional who can not only help you build the plan, but also ask the critical questions, right? You know, a good a finance person will be able to ask you the questions that, you know, between the two of you, you can kind of answer, and that'll help drive, you know, the assumptions in the model that ultimately drive the financial projections and plan that you're putting together.
So we have one last question before we close. And they say, you mentioned to focus on a 3-year forecast. How to reconcile with presenting the 1 billion opportunity? We're often asked to show how and when our business can hit 1 million plus revenue.
Yeah, so I think that depends, right? And when we say that you should focus on a 3-year plan, I think what we're suggesting is that, again, we're kind of looking at this from an investment standpoint, right? So part of your investor's pitch, your pitch deck is going to be discussing kind of long-term growth opportunities, right? The market size, potential, how we're going to grow into this market space, and when we expect to achieve certain revenue milestones, let's say $1 million, $10 million, whatever it may be. And so that will be part of your investor presentation. But in terms of the actual financial plan that you present, and that you prepare, that helps to identify the milestones that you're trying to achieve and how much money you're trying to raise in this round of financing. The 3 million, the 3-year plan may or may not get you to that $1 million in revenue, or you may be blowing through it in 3 years. It's really hard to say, without really understanding the particulars. But if you think about it, so from an investor standpoint, they're going to say, okay, you're coming, the founder is coming and they're pitching this idea. They've put together a 3-year plan. I know I'm going to be funding the first 18 to 24 months of this plan. Does that make sense to me? Obviously, you want to be able to instill into their minds the kind of the pie in the sky idea of how big this company might be over the long term. And you want them to be thinking about that as they make the decision. But the actual financial plan you're putting together is really going to be more grounded in reality, with some obviously bent towards optimism. But it's going to be more grounded in reality. And if you're not getting to $1 million in 3 years, then you're not getting to $1 million in 3 years. And the pitch should be why that's appropriate for your company and your business. I hope that answers the question.
Perfect. I think we are going to close now. I will send this presentation and the link to rewatch it on YouTube later today. If you have any questions, please let us know through email. Yes. Thank you very much. Bye.
Thank you, everyone.